Now, in this video, we're going to talk about this idea or notion that you can settle your tax debt with the IRS for less than you owe and get a fresh start, a clean slate IRS. A lot of people ask, can you really settle your tax debt with the IRS for less than you owe? And the answer is yes, you absolutely can, and it's done through a program called an offer and compromise. Now, there's been some really exciting developments with this program that came out as part of the IRS's Fresh Start initiatives, and they made some changes in May of 2012 that could really benefit some taxpayers. What exactly is an offer and compromise? Well, an offer and compromise is basically an agreement between the taxpayer and the IRS that settles the taxpayer's past due bills for less than the full amount owed. A taxpayer can be an individual, married couple, trust, corporation, limited partnership, limited liability company, a foundation, association, or other nonprofit organization, or even an estate of a deceased person. And people will ask, well, how is this possible? Well, the IRS, like any other creditor, is going to look at a taxpayer's financial condition to determine if there's any realistic chance that the taxpayer would ever be able to pay off the tax debt in full within the foreseeable future. And in particular, the IRS is going to look at the taxpayer's income and assets, compare them to some national standards that have been set up for living expenses, and determine if there's any discretionary income left over at the end of each month. So exactly how much will the IRS settle for? Well, the IRS is going to apply a formula to the taxpayer's assets that they have. Then they're going to take a look at the taxpayer's discretionary income to determine what they call future income. And then the IRS will combine the two to determine a minimum settlement that they would accept. And there was some great news, like I mentioned before, in May of 2012, where the IRS made some key changes to this program. One thing the IRS did was broaden and increase the national standards that they use for calculating living expenses. And this would allow the taxpayer to keep more of their income to live off of, thereby decreasing the amount of discretionary income used in the future income calculation. The IRS also relaxed some rules and formulas for evaluating assets and whether or not an asset should be included in the settlement amount. The IRS also made a change to the future income calculation. Now they calculate it over a 1 to 2 year period instead of a 4 to 5 year period they used in the old way. So let's go through an example here. Let's say a taxpayer owes the IRS a total of $100,000 in taxes, interest, and penalties for several different tax years. Let's say a taxpayer has $10,000 in the bank, but $2,000 of that is saved up from paychecks and is designated for upcoming mortgage and automobile payments in their budget that are due in the next few weeks. And let's also say that after all the allowable living expenses, the taxpayer has a monthly discretionary income of $250. Well, in the settlement calculation, the IRS is actually going to allow the taxpayer to keep the $2,000 that's designated for upcoming mortgage and automobile payments in a couple weeks that they set aside from their paychecks. Plus, the IRS will automatically exempt $1,000 of the taxpayer's cash in the bank from that calculation. So only $7,000 of that $10,000 that the taxpayer has in the bank will be included in the amount that the IRS would require for a settlement. Now, if the taxpayer is going to pay this settlement amount off in 5 months or less, the IRS will calculate future income based on 1 year. So they would allocate that $250 a month in discretionary income for each month for 12 months, and they would include that total amount in the settlement amount. So that would be a total of $3,000. If the taxpayer needed a little bit more time to pay off this settlement, more than 5 months, up to a maximum of 2 years, the IRS would actually use a 2-year formula for that future income calculation. So that $250 in discretionary income will be allocated for 24 months to be included in the settlement amount. So that would be a total of $6,000. So what this turns out in this example is the taxpayer could actually settle their $100,000 tax debt with the IRS for $10,000 if they agreed to pay it in less than 5 months. That would be the $7,000 from the bank, and the $3,000 from the 1 year of discretionary income. If they could pay that off in a lump sum or in less than 5 months with 5 equal monthly payments, they could settle that $100,000 debt for a total of $10,000. Or if they need a little bit more time, the IRS would settle it for $13,000. The $7,000 from the bank calculation plus 2 years of discretionary income over that 24-month period would be $6,000. So it would be a total of $13,000 that would have to be spread out in equal monthly payments for 24 months or less. Now, before May 2012 changes, under the old calculations, the taxpayer would actually have to pay a significantly more amount to settle their tax debt. The full $10,000 the taxpayer had in the bank would actually have to be included in the settlement offer. And the taxpayer would either pay by lump sum or spread the payments over 5 years or 60 months. If they're going to pay in a lump sum, then the future income calculation for that discretionary income would be spread out over 4 years. If they were going to make payments for 5 years or 60 months or less, it would actually be calculated at 5 years. So in that old scenario, if the taxpayer was going to pay a lump sum, one-time settlement offer to pay off the IRS and settle their debt, they'd have to offer $22,000 to do so. The $10,000 in the bank, and then $250 discretionary income a month times 48 months. If the taxpayer was going to make monthly payments for 60 months or less, then it would actually be $25,000, $10,000 in the bank, and then the $250 times 60 months, and they would spread the $25,000 over equal monthly payments for 5 years or less. Now, this example is for illustration purposes only, just to show you how the program has changed and how it works. But don't consider this in any way applicable to your personal situation. It's just for illustration purposes. The reality is, if the IRS believes they can actually collect the full amount of tax owed, either by a lump sum from selling your assets, or if they seize your financial accounts, or if they think that you can afford a payment plan over 5 years or less that would pay off the balance, interest, penalties, total amount of tax owed, they're not going to accept the settlement offer. Now, some other considerations. An offer in compromise is a settlement with the IRS, just like you negotiate a settlement on any other loan or creditor that you have, credit card, things like that. So it is a negotiation. Negotiations for settlement with the IRS usually get sticky on a few points. First off, if your monthly expenses are greater than the national standards they have set up, you will have to make a strong case to the IRS that they should be allowed, that the extra that goes over and above those national standards should be permitted in your case. It's not impossible to convince them of that. You just have to make a very strong case for them to allow you extra expenses. Secondly, if you have any income producing assets, if you've got equity in cars or boats, equity in real estate, if you have a retirement account, business assets, and money needed to run daily business operations, if you have assets that you've sold or transferred to someone else within the past 3 years, things like this can add some complications to negotiating a settlement. So a lot of people ask, is it really simple? Can I do this on my own, or do I need professional help? Well, like anything else, I think you'd have to come to that conclusion on your own, based on your own personal situation. If you feel like it's something that you can handle on your own, if you're comfortable with this type of financial calculations and dealing with the IRS, you can go to the IRS website at irs.gov. There's a Forms and Publications tab. You can click on that. You just search for Form 656B. It's actually a booklet for offer and compromise, and it'll have instructions to walk you through how to actually fill out the paperwork and file an offer to settle your tax debt with the IRS. The reality is, these things can get complicated, and most taxpayers are going to be better served by hiring a professional that's qualified and experienced, or a firm, not only because of the considerations that I mentioned earlier, but because there are some important legal requirements that settlement offers are subject to before the IRS actually accepts them, and it's important for the taxpayer to understand and be informed of those legal requirements. In addition to the fact that the fees that most professionals charge to handle this for a taxpayer are actually pretty affordable, pretty reasonable. and it's worth investing that little bit of extra money to get the best deal possible. Now, if you're unsure about your situation or like a professional opinion as to your options, just by watching this video, you're entitled to a free consultation. So visit the Lazat Law Group at getllg.com. There's a tab there. You can click on it for a free, no risk, no obligation, 30-minute consultation to discuss your options. This will be a phone consultation, so you can be located anywhere in the United States, and you're more than welcome to take advantage of that opportunity.